Hi and welcome back to Financial Autonomy. I'm Paul Benson, Certified Financial Planner at Guidance Financial Services. You're listening to the second episode in our Financial Essentials series, where we're bringing back some of the most useful episodes from the Financial Autonomy archive. This series is designed to help you cut through the 400 plus episodes in the back catalogue and find the conversations that are most worth your time. The ones that cover the core principles, answer the questions we hear most often, or explain ideas that are worth revisiting. Today's episode is one of those. It covers a concept that sits underneath so many good financial decisions, and whether you're hearing it for the first time or coming back to it again, I think it's well worth the listen. I hope you enjoy this Financial Essentials episode. Welcome back to the Financial Autonomy Podcast. My name's Paul Benson, Financial Planner and Practice Principal at Guidance Financial Services. The desire for passive income frequently comes up as a goal when I speak with new clients. The idea of earning money before we even get out of bed holds obvious appeal. So this week in the podcast, I thought I'd cover all there is to know about passive income, where it can be sourced, how you can create it, some of the challenges and misconceptions, tax considerations, and some tips for success. Without further ado, let's dive in. What is passive income? Let's kick off with the definition. In our normal working lives, we generate income through doing something useful. We provide some of our time and experience and get compensated accordingly. This type of income can be considered active income. Passive income, therefore, is any other form of income. So things like dividends on shares that you own, rent on an investment property, or interest on your bank account. Passive income isn't free, though. Rental income, for instance, frequently entails a whole bunch of landlord-related headaches. It's also the case that unless you're someone who happened to have had the good fortune of a rich uncle or auntie leaving you millions, you have to save and sacrifice to acquire the assets that ultimately produce your passive income. So why is passive income so sought after? You've chosen to listen to a podcast called Financial Autonomy, which suggests that you're thinking about financial independence and wanting to have flexibility and choice in life. It's for someone with this type of mindset that passive income holds such a strong appeal. Passive income could be what unlocks the ability to make a career change, cut back to part-time, or perhaps retire entirely. Passive income gives you security and options. Sources of passive income. The most passive of passive incomes is likely to be returns on financial assets. We're talking here about dividends from shares, interest from your bank savings, distributions from your listed real estate trusts, and perhaps income from your bond portfolio. Real estate income is the next most common form of passive income. Rental properties require maintenance and tenants change over, so relative to financial assets, income from real estate is a little less passive. Nonetheless, particularly if you use a good agent, income generated from your real estate investments likely requires fairly minimal input from you. Business ownership can be another source of passive income. Perhaps you made a small investment into a local bar, or you've inherited a stake in the local bus company. These type of assets can often produce quite high levels of passive income. However, their variability and uncertainty are far higher than financial or property assets. Royalties can be another form of passive income, though this is a bit of a grey area. I still receive royalties for my Financial Autonomy book, which is pretty fantastic considering I wrote it about 5 years ago. But the process of writing it, the back and forth with the editing, providing feedback on the layout, etc., there's a lot of work. The work to generate this income, therefore, is front-end loaded. And look, perhaps that's not dissimilar to financial or real estate assets, where you first need to utilise your surplus income to acquire the assets. But I guess the key is it's passive at the back end, but there's a lot of active work required to get it happening in the first place. Challenges and misconceptions of passive income. The greatest challenge when it comes to generating passive income is the initial capital required to acquire the assets that will throw off this income. I've noticed that this often aligns with a common misconception that if we reach a point where passive income covers all our living expenses, we'll achieve a state of complete financial bliss. There's three elements where this can fall down. The first is that sometimes people with this mindset will rationalise that it makes sense for them to work 100 hours a week, busting their ass for that perceived lottery win 10 or 20 years down the road. Too often, their health and their relationships suffer. The second is that in trying to accumulate the capital to generate a meaningful sum of passive income, they invest in high-risk investments that they don't understand. Essentially, impatience works against them. And the third is that all the research shows that happiness comes from having a sense of purpose and connection. Building a source of passive income so that you can cut down to 2 days a week of paid employment and volunteer the other 3 days into a community group that you're passionate about, well, that makes a ton of sense. But generating passive income so that you can have an empty calendar is unlikely to get you into a happy place. Another common misconception that I come across amongst those with a passive income mindset is the idea that you can never sell down capital. When it comes to stock market investments, many of the most lucrative opportunities produce little or no dividend income. If you take the view that the only way you can gain choice and flexibility is through holding assets that throw off dividends, your portfolio will eschew these investments to the detriment of your total wealth. It is totally reasonable to sell down investments to produce the income that you require. Imagine you had a $1 million share portfolio that grew in value by $100,000 over the course of a year. If you sold $80,000 worth of shares from that portfolio, the total value will still have grown, whilst you've given yourself money to live off. Depending on your age and broader goals, it could even be that you sell down such that your initial capital declines. Refer to Die with Zero for a bit of more thoughts on this one. Okay, what about tax considerations for passive income? Tax outcomes vary widely depending on the magnitude of your passive income and what else you're doing with your time. Share income in Australia produces franking credits, and where you don't have sufficient tax liability to actually require these credits, they can even be refunded to you. Effectively, in that circumstance, that they act as a top-up to your dividend, which is just incredibly generous. Rental properties might have depreciation, and they'll certainly have other costs that can be tax deductible, things like your water rates, perhaps agents' fees. Of course, if you've got borrowings against the property, then there's also a deduction for the interest expense. However, whilst debt sits against the property, it typically isn't a passive income producer because you're using the rental income to pay off the debt. As mentioned earlier, a legitimate strategy is to invest in growth assets and then sell down that growth to provide cash flow. In this instance, capital gains tax is triggered. Given capital gains receive a 50% discount provided the asset has been held for more than 1 year, producing income this way can be quite tax effective, particularly as you can manage the timing of the gain to suit your particular tax position. Okay, let's wrap up with a few tips for success. By far the most important thing is to get started. Establish that investment portfolio and contribute to it every month. If you're borrowing to accelerate your progress, whether via a share portfolio or a property investment, the sooner you get cracking, the better. Next, be patient and realistic. You won't wake up one morning having seen the light that passive investment is the goal that you should be striving for, and then a year later find that you've ticked that off and can spend your days at the beach. Your passive income strategy is likely to take 10 or 20 years, could even be more. Finally, I'd encourage you to not put all your eggs in one basket in pursuing passive income. There are things you can do in your 20s and 30s like cheap travel, perhaps casual work, that you might not be able to do later in life, particularly if you have a family. Likewise, in your 70s and 80s, you might lack the physical ability to do some of the fun things that were available to you in the middle of your life. So by all means, accumulate wealth and work towards the generation of passive income as a way of giving you choice and flexibility, but be mindful of the need to strike a balance. The journey can sometimes be more fun than the destination. And if this episode has made you realise that maybe it's time to get personalised advice for your finances so you can see what's possible, so you can stop worrying about your future, you can book a meeting through the link in our show notes. All right, well, look, thanks for listening to this week's episode. If you found it helpful, share it with a friend who you think might benefit too. Of course, be sure to subscribe to the podcast so that you never miss an episode. And if you want to stay across all things, finance, headlines, plus a really fun quiz of the week, then make sure you subscribe to our Gaining Choice newsletter. And there's a link in the show notes for you to do that. Okay, bye for now.